Okay, we will read it together. GL Limited is a multi-product manufacturing concern functioning with 4 divisions. So there is GL Limited. What is GL Limited? GL Limited is a multi-product manufacturing concern functioning with 4 divisions. So it has got 4 divisions. Okay, division 1, then 2, 3 and 4. Produces many products. Okay. Then the electrical division of the company is producing many electrical products including electrical switches. Okay, so there is one division, electrical division. Electrical division is producing many electrical goods including electrical switches. Okay, then the division function, this division functioning at its maximum capacity sells its switches in the open market at rupees 25 each. So external sales at rupees 25 per unit. Then the variable cost per switch to the division is rupees 16. So variable cost at rupees 16 per unit. Now going further, the household division, another division of GL Limited, functioning at 70% capacity, asked the electrical division to supply 5,000 switches per month at the rate of rupees 18 each. Okay, so there is another division, household division. Household division. What household division is requiring? It is functioning at 70% capacity. It is functioning at capacity. Okay, ask the electrical division to supply 5,000 switches per month at the rate of rupees 18 to fit in the night lamps produced by it. So require 5,000 units at rupees 18 per unit. 18 per unit. Okay, now the total cost per night lamp is being estimated below. Components purchased from outside suppliers, it will be 50. Then switch if purchased internally, 18. Then other variable cost, 40. Then fixed overheads, 21. Total cost per night lamp is 129. The household division is marketing night lamps at a price of rupees 130 each. So night lamp. With a very small margin, as it is doing business in a very competitive environment. Any increase in price made by the division will push out the division from the market. It's very important. They can't increase the price of the product. Therefore, the division cannot pay anything more to switches if the electrical division. Therefore, the division cannot pay anything more to the switches if the electrical division demand. Please include demand. Okay, further, the manager of the division informed that it is very much essential to keep on the market share for night lamps by the household division to retain the experienced workers of the division. So what's happening is they cannot increase the price. If they increase the price, what will happen? They will have to go out of the market. And also, second thing, they will have to keep the existing market share. Why they have to keep the existing market share? Because there are employees. Okay, and these employees have to be retained. Experienced workers have to be retained. Those experienced workers can be retained only if this same volume is maintained. So there is no scope for increasing the price. If they increase the price, the volume will come down. That cannot be permitted. The company is using return on investments as a scale to measure the divisional performances and also marginal costing approach for decision making. Would you recommend the supply of switches to household division by electrical division at a price of rupees 18 each? Substantiate your recommendation with suitable reasons. Now analyze whether it would be beneficial to the company as a whole the supply of switches to household division at a unit price of rupees 18 per 18 by electrical division. Do you feel that the divisional manager should accept the interdivisional transfers in principle? If yes, what should be the range of their transfer price? Suggest the steps to be taken by the chief executive of the company to change the attitude of divisional heads if they are against the interdivisional transfers. Okay, so this is a question. Now, what's happening here? As far as division A, electrical division is concerned, okay, they are selling the electrical switches at what rate? At rupees 25 per unit. Okay, that is the external demand. Now, is there any information regarding the capacity? Is there information regarding the capacity? Maximum capacity. The division is functioning at its maximum capacity, sells its switches in the open market at 25 each. The variable cost is rupees 16. Okay, so right now this division is functioning at maximum capacity. Okay, and what is the contribution per unit? Contribution per unit is 25 minus 16, so it is 9 per switch. Okay, now there is a demand for 5000 units of internal transfer, and this household division requires the switches to be transferred at 18 per unit. Now, do you think that they will be able to get, or they will be able to procure transfer these goods at 18 per unit? No. Why it is not possible? Because in the case of electrical division, they are currently operating at maximum capacity. So even if they want to undertake any internal transfer, they have to divert from the existing sales. Existing sales is giving a contribution per unit of 9 over and above the variable cost. Variable cost is 16. So 16 plus 9, 25. 25 is the minimum selling price required by electrical division. Okay, now household division, can they accept this? That is something different we have to see. So the first question was, what was the first question? The first question was, would you recommend the supply of switches to household division by electrical division at a price of rupees 18 each? Answer to that. Okay. 1. Currently, you can write currently the electrical division is operating at 100% capacity. 100% capacity. Is it clear? Okay. Thus, any internal transfer can be done only by curtailing or deviating from the existing external sales. Okay, now loss of external sales will result in loss of contribution, that is rupees 9 per switch. Rupees 9 per switch. Loss of contribution, that is rupees 9 per switch. Is it clear? Yes. Therefore, minimum transfer price required by electrical division is equal to what? Variable cost plus opportunity cost. What is variable cost? Variable cost is rupees 16 plus what is opportunity cost? Contribution foregone, that is rupees 9. So that will be rupees 25 per switch. 25 per switch. Therefore, it is not advisable to effect internal transfer of 5000 units of switches to which division? Household division, as it will result in a loss of profit or contribution of 5000 units into rupees 25 is the minimum, and what is the price they have quoted? Rupees 18. Okay, so 7 into 5000 will be rupees 35,000. Okay, so it is not advisable. That is our conclusion. So that is question number 1. Would you recommend the supply of switches to household division? We will not recommend. Okay, now analyze whether it would be beneficial to the company as a whole the supply of switches to household division at a unit price of rupees 18 per electrical division. Yes. Is it okay? Now how to take that decision from the company's perspective? They have given the information from regarding the cost structure of the night lamp. Okay, what is the cost of components purchased from outside suppliers? It is 50. Now switch, if purchased internally, it is 18. Now other variable cost, what is the other variable cost? It's 40. Now fixed overheads 21. Then total cost per night lamp, it is 129. Okay, and what is the price at which they are selling? They are selling it at rupees 130. Okay, now so this fixed overhead is basically a apportion cost. It is an apportion cost which will be incurred irrespective of whether this lamp is sold or not. So it is not a relevant cost. So not a relevant cost. Okay, similarly, if you see the okay, it is not a relevant cost. And also if you see the cost of switch, what is this cost of switch? It is 18 rupees. What is this 18 rupees? It is the transfer price recommended by the household division. Okay, household division from whom? It is from the other party, who from the electrical division. So as far as the company is concerned, the cost of this switch is only rupees 16. Why rupees 16? It is variable cost. Okay, that is a variable cost. So even though the transfer price is 18, the real cost as far as the company is concerned, the cost of switch is only 16 rupees. And that 16 rupees is not a relevant cost. Why it is not a relevant cost? If this sale lamp is not, if this sale lamp is not sold, then this switch will be sold into the external market. It will be sold in the external market. So as far as the external market is concerned, okay, there also the 16 rupees cost will be incurred. Here also it will be incurred. So that is not a relevant cost. So what is the net relevant cost out of this? It will be 50 rupees is a out of pocket expense, so it is relevant. Okay, then out of that 2 rupees is relevant because that is nothing but the margin. Then 40 other variable costs, this is relevant. Then fixed overheads, it is not relevant. Okay, and what is the selling price? Rupees 130. So we will do one thing, we will find out benefit to the company. Benefit to the company on selling the lamp. Okay, on selling the lamp, what is the benefit to the company? Okay, we'll find it. Net selling price. If one lamp is sold, what would be the rate? It is 130. So they will get 130. Okay, now less relevant cost of sale. Okay, which all are the relevant cost of sale? Components purchased from outside suppliers. Is it a relevant cost? Yes, it is a relevant cost. Why it is a relevant cost? It will be incurred only if the product is sold, or if the product is sold, this will be incurred. So component cost, okay, purchased is 50 per unit. You can write relevant cost since it is an out of pocket cost. Next, cost of switch. Cost of switch to the company. Okay, nil. Why nil? Why nil? Because as far as this decision is concerned, as far as this option is concerned, this cost will be incurred irrespective of whether the lamp is sold or not. Hence it is a irrelevant cost. It is a irrelevant cost. Okay, now which is the next cost? Other variable cost. Definitely it is a relevant cost. So other variable cost. What is other variable cost? Other variable cost is 40. Then next, fixed overhead. Is it relevant? No. Fixed overhead. So you can write apportion cost not relevant. Okay, therefore net relevant benefit from single lamp, it will be 130 minus 90, so 40 rupees. Now what you have to do, if the company wants to sell this lamp, then they will have to do what? They will have to curtail the existing sales of electric switches. So there is a contribution loss that has to be set off here. Okay, so you have to see here net relevant benefit per switch, per lamp. Okay, now less opportunity cost. What is opportunity cost? Company will have to curtail the sale of switches in the external market. Is it clear? So opportunity cost will be contribution foregone plus cost of switch. Why cost of switch? Cost of switch is a relevant cost. So when you compute the contribution foregone, it has to be, you cannot consider the cost of switch there. Okay, so here it will be rupees, the contribution foregone here was how much? Rupees 9 plus what is the cost? 16, so that is rupees 25. Okay, so net benefit on each lamp. Okay, how much? 40 minus 25 will be rupees 15 per unit. Okay, so what is the conclusion? Conclusion is the company earn a net benefit of rupees 15 per unit on each lamp sold. Therefore, from the company's perspective, the household, the electrical division perspective, the electrical division should transfer the switches to the household division. Okay, this is what we call as conflict. Okay, as far as the electrical division is concerned, they can transfer the goods only if they get a transfer price of 25. But if electrical division is charging a transfer price of 25, will the household division buy it? No, it cannot buy, because if the maximum margin it is getting is only 18 rupee. Sorry, 1 rupee. Okay, after considering 18 rupees cost as far as the household division is concerned. Okay, so household division will not buy this switches from the electrical division if they are going to transfer, if they are going to quote a transfer price of 25. So now the company is seeing, when the company evaluates on when each lamp is sold, it is getting a net benefit of how much? 40,000. And for selling one unit of 40 rupees, now for selling each unit of lamp, they will have to forego what? 1 unit of sale or switch. But on selling one switch, they will get a gain of 25 rupees only. But on selling one lamp, they are getting how much? 40 rupee. So as far as the company is concerned, it is always better to curtail the sale of the switch and to sell the lamp. That is from the company's perspective. Okay, but from the division's perspective, it is better not to do the internal transfer. Okay, so there is a conflict of interest. Now what you have to do, that is the analyze whether it would be beneficial to the company as a whole to supply its switches to household division at unit price of 18 by the electrical division. Do you feel that the divisional manager should accept the interdivisional transfers in principle? If yes, what should be the range of transfer price? Okay, so what you can write here is, please write, okay, in the given case, the divisional managers should accept the proposal for internal transfer as it is in the best interest of the company. However, from the divisional perspective, such a decision may affect their profitability. Okay, their profitability. Therefore, even though it is against the interest of the division, they should accept the proposal to bring goal congruence. Okay, now the range of transfer price. Please write the market price of rupees 25 per switch. The market price of rupees 25 per switch leaves the electrical division in an identical position to sell the switches in the outside market. Therefore, the maximum price shall be rupees 25 per unit. However, division household will not be able to pay anything more than how much? What will be the ability to pay of this division? The selling price is 130, okay, minus 50 rupees they have to pay for purchasing the component from outsiders. Also they will have to pay what? This 40,000. So minus 40. So balance will be 90. So 40. Okay. So division household will not be able to pay anything above rupees 40 per unit, per switch, not per unit, per switch. In bracket you can write, sales revenue minus out of pocket expense. Which are the out of pocket expense? This 50 and this 40. Okay, because when they get 130 rupees, out of the 130 rupees, 50 rupees will have to be paid for these components. Then switch, of course, that is to be what we need to compute. Then 40 rupees have to be met on account of variable cost. And what about this 21? It need not be paid because it's only an apportion cost. So the out of pocket expense is only 50 plus 40, 90. So that means they are having a surplus of 40. Okay, so therefore the maximum amount that household division can pay that the household division can pay is rupees 40, is rupees 40 per unit, is rupees 40 per unit. Okay, therefore the transfer price should be fixed, the transfer price should be fixed between rupees 25 to rupees 40, rupees 25 to rupees 40, as it will benefit both the divisions, as it will benefit both the divisions. Okay, now next is the fourth one. Suggest the steps to be taken by the chief executive of the company to change the attitude of divisional heads if they are against the interdivisional transfers. Okay, what you have to do, you can suggest about the dual rate transfer pricing system and two-part transfer pricing system. Okay, we will conclude the answer in one sentence. Okay, now please write. The chief executive of the company should induce the divisional managers for effecting the internal transfer, as it will be in the best interest of the entity. However, in order to resolve the conflict, between them, they shall either opt for one dual rate transfer pricing system, two two-part transfer pricing system, and you have to give a explanation about what do you mean by dual rate transfer pricing system and what do you mean by two-part transfer pricing system. Okay, so that is the steps that can be taken by the this one. And after that you will have to also write, please write, also the chief executive should make it clear that the organizational interest should be given highest priority over the divisional interest. Okay, that is the last sentence, because after telling all these things, the chief executive should ensure that the divisional managers know that they should give preference to the organizational entity, not to the divisional interest. Okay, so that's all with this question. Now two more questions are left out, question number 5 and then question number 6, and you have one more question, that is one small question, that is question number 7. Okay, so for the time being, for today we will stop. Okay, so as I told you, we will have one more session for standard costing in the coming week. I will inform you the date, whether it is on Saturday or Sunday. I will explain you. Okay, and based on that class we will complete the standard costing. Okay, and then we will see the balance topics. I will give you as recorded lectures. Okay, so for today we will stop. Thank you.